Hey everyone, welcome to Market Radar. We are not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. It's February 27th, 2022. My name is Artie and I'm here with Gamma.
Hey guys.
So let's get started here. Year-to-date performance, S&P 500 is down 7.83%, NASDAQ 100 down 13.09%, Russell 2000 down 8.97%, and Dow Jones down 6.27%. So everything's getting fucked right now. All major US indices are printing bearish trends on our DDAP indicator. We've got our macroeconomic regime here. As you can see, the past 5 weeks has been stagflation. We're still in stagflation. Stagflationary odds are rising, so we're getting a stronger stagflationary regime as each week goes by. But as you can see, deflationary odds are also rising while inflationary odds are lowering. So essentially, stagflation right now, if you don't already know, it's rising inflation, decreasing growth. A shift to deflation is going to mean decreasing inflation and decreasing growth, which that is usually accompanied by market sell-offs and higher volatility and TLT rising.
So long story short, Artie, we are currently not bullish on risk assets.
No, definitely
Yeah,
not.
not at all. And it's important to note that this is one of the longest recorded histories of stagflation in over the last 10 years. So since the GFC, the Great Financial Crisis, this is one of the longest periods of recorded stagflation.
Yeah.
And the reason that's important to note is a lot of things didn't start to get hit until, the end of the year, but the factor exposures really led the way down. Things like small cap growth were getting destroyed from May of 2021. And as you know, the way risk flows, it flows from the smallest to the largest. So the more sensible things, the things like small caps, micro caps, basically all risk assets get hit first, and it fades all the way up to the large cap, high beta names that you know today, like Apple, Amazon, Netflix, Facebook, etc. And that's what you're seeing with the market right now. The market's pretty much pricing in a pretty shitty stagflationary period. Not deflation, though, because if we were getting deflation, you would at least see some love for the TLT or Treasury bonds. Those are getting no love as well. And that's the problem that we're running into. So if you're long risk assets, be careful, because a pivot to deflation will be even more destructive than what you've already seen. And going into next week, we have some important events, starting with PMI and ISM manufacturing on Tuesday. We have a bunch of Fed speakers speaking throughout the week. We have Powell's testimony on Wednesday, and Thursday, and the market's going to be looking for his tone and his attitude towards what he is seeing and how he's presenting it to the public. Because at the end of the day, the FOMC meeting is right around the corner. It's roughly 2.5 weeks from now. So the way he approaches the testimony and the way he talks about the market will give us some type of feeling of where we might go. The interest rate hike, the interest rate hike odds have been all over the place. We were all the way up from 8 hikes to 4 hikes, now to 6 or 7 hikes. No one really knows what's going to happen, but I can certainly tell you that with what's going on right now in Ukraine, Russia, this whole geopolitical setup, inflation is not looking like it's going away anytime soon, which means we're going to have more action from the Fed. And just this weekend, we had some big headlines come across where Russia is being removed from SWIFT. Now, Artie, if you want to go into some detail on what SWIFT is.
Well, basically, that means that no country can do business with Russia with oil, and that's one of the biggest exports of Russia, and one of the biggest imports of the European Union.
Right.
So
Yeah.
that's going to have
Yeah.
some
That
massive impacts.
100%. Like we also have I guess not politicians, some countries now negotiating on whether they're going to keep Russia on the SWIFT system or exempt them, or I should say, if they're going to keep certain energy transactions on the SWIFT system, meaning they want to get Russia off the SWIFT system, but they want to leave some energy specific transactions on there, which makes no sense. Either they're on or they're off. But I understand what they're trying to do. Like you said, Artie, I think it's like 40% of Europe's energy comes from Russia. So a de-link from the SWIFT system would be detrimental, and I wouldn't actually be surprised if later today, as we're recording this on Sunday, so Sunday night futures, we see some energy gap ups across crude and Brent on this news.
Which that's going to boost inflation big time.
Exactly, and that's what I was
So
that's what I was mentioning earlier. The
we
Fed is go ahead.
we have deflation odds rising, but like you got to keep in mind that our model is still pricing in stagflation. We're not pivoting our positions until there's a clear winner. And yeah, deflation odds might be rising, but until they're on top, there's no reason to stray away from a stagflationary position. And stagflationary position, essentially, you got to be a large position in cash, and a lot of hedging. So hedging
Right,
high beta with low beta.
you know what
Yeah.
I'd like to break in here and just like mention this with stagflation. Um, Usually stagflation precedes deflationary environments. So it's important to pay attention where, like as you said, the deflationary odds are going, because as they rise, we get closer and closer to a potential regime pivot. Now, the only problem with having a deflationary regime pivot at this time is it's very unlikely, even though the odds are rising, and that's because of inflation. Now, I don't mean the regime inflation, I'm talking CPI. We were talking earlier about Russia and the SWIFT system and the potential effects to crude, which energy is a big component of CPI. So you're seeing energy prices rise. You're basically seeing CPI go up with it. Now, there's a lot of people that say inflation's transitory, that it's going down or it's peaked. We're pretty much from the camp that we'll believe it when we see it, because we just had crude on Friday hit $100 a barrel.
Yeah.
Now, that's not something that's signaling a slow in inflation. That's something that's signaling constant or accelerating inflation, which means the Fed is between a rock and a hard place.
Well, so we essentially got two options here. We have inflation decreasing, which would bring us to a deflation, or we have growth increasing, which
That's
brings
a good
us
point.
to expansion.
That's a good point. Right.
What would have to happen for growth to increase?
Well, for that, you'll have to see a pickup in all of the names like ARK, any small cap names, the Russell. You have to really start to see them pick up and bottom out and accelerate higher. But more importantly, you have to look at it from an economical perspective, right? The Fed is going to tighten, and the liquidity is not there. So they are going to begin tightening with basically in a low liquidity environment. The Fed's notorious for this. The Fed is an organization
they're always delayed.
Yes, they do things to not scare the market. Their number one thing is they don't want to scare the market, which means they're going to do QE until they're not going to do QE. And what I mean by that is they are increasing their balance sheet every month. Back in December, we had the minutes that showed that the Fed is going to I believe it was January, excuse me. January, the meeting came out, interest rates were unchanged, and the Fed basically came out and said that they're going to start QT in the next meeting. They're going to start reducing the balance sheet in March. And they are also looking to do an interest rate hike. Problem is it's now end of February and they're still expanding the balance sheet. So they're basically going to expand the balance sheet until they're not going to expand the balance sheet, even though that they know that expanding the balance sheet is no good at this point, as they've done too much.
Yeah.
So it's almost counterintuitive because they're creating more of a problem as time goes on to then fix their problem later. It's really extraordinary if you think about it.
So, bottom line, what's the play here? What's the play to make money? Right now, we have stagflationary positions, which is mostly cash, and
Right.
we got a little bit of volatility position in there. We've got high beta and low beta spread. What other way to play this? And should we be preparing for a deflationary regime?
I think that's a good question, and I want to start that question off by answering with all the things that we shouldn't do. Okay.
Yeah.
So,
don't buy
it's
small
very,
caps.
you know, well, yeah, obviously everyone knows that, but
Yeah, I don't know if you
a
guys
lot
know
of
Zach Morris, but if you do follow his plays, you got to be very careful. This is not a small cap environment. There's a reason he got dicked down these last few months, and there's a reason for his come up earlier.
right, that's a good point.
Small caps were ripping because the Fed was printing money hand over fist after COVID. That was his entire success, and now you can see he's crumbling because small caps are getting dicked. And in a stagflationary environment, deflationary environment, they're going to continue to underperform.
Right, and simply put, the verified traders got smoked. That's what happened.
Yep.
The verified Twitter traders got smoked. And the problem to this is a lot of people are blindly following these calls, and it's not so much the trader's fault. It's, it has a lot of FOMO, a bunch of emotional things attached to it. Everyone wants to, print 1 million overnight. That's how it works, right? But what's crazy is eventually these Twitter traders, they're going to kill it again eventually. It's a sad, you could say that right now is a sad time for them, but they're going to kill it again in the next expansion or inflation, aka risk on regimes. Right now we're in a risk off regime, stagflation, deflation being risk off, but risk on, they'll kill it again. So it's a matter of withholding the storm, and they're just facing ridiculous drawdowns where I don't see it. I don't see how a typical investor can handle these things without quitting on investing entirely.
Yeah, this is not the dip to buy, regardless of what you see. Everyone's saying buy the dip. This is not the dip to buy. The dips to buy are the dips that occur during inflationary and expansion regimes. Those are easy.
Risk on.
Yeah, risk on regimes. Those are the easy dip buys that we take part in.
Let me loop back to what I was saying earlier on what not to do, because I think this is important. A lot of people are looking at the market right now, and they're basically saying, let's pull up ES here. For those that don't know, this is our DDAP indicator. There's a video on our YouTube channel explaining more, but let's get into the current situation of ES, right? For the past year and a half, there have been very shallow dips, less than, I think it's 10% already, or is it 5? We haven't had a dip of 10%, I believe, in over a year and a half, right?
Yeah, it's been a while.
Yeah, so these 5% shallow dips were being basically gobbled up by everyone. So now we have a situation where we get the dip and it keeps on dipping, and now we're somewhat looking like there's some bottoming action going on here. And not that we're saying that this can't go higher. It's more of, if this goes higher, it's something to be sold into rather than bought. And the number one thing we would not be long right now are risk assets. Okay. Do not long risk assets. We will long risk assets eventually when the time makes sense. But as of right now, the environment and the outlook, there's too many headwinds to go long risk assets at this point. The next thing is the gold bugs. Now, we all love gold, right? Everyone likes a nice gold watch, gold, gold jewelry, the whole nine. Everyone wants to own gold, right? That's the whole point. And everyone loves gold as a gold is the original Bitcoin, believe it or not. So like before Bitcoin was around, everyone thought that gold was the way to basically distance yourself from the institutions. You were able to get away from institutional entanglement, meaning if something went under, or 2008 basically, if something like that happened, your gold would provide value for you at home. That's what gold was. Then Bitcoin came out, right? We'll get into Bitcoin later, but realistically, gold isn't going to perform the way that everyone thinks it's going to perform for one main reason, and that's real yields. What are real yields? Real yields are the current interest rate, and it's the difference between the current interest rate and the break-even inflation rate, right? So if we go look at the real yields right now, real yields are negative 57 basis points.
So that,
and what
that
does
basically means you're losing money due to
pretty much
inflation every time
pretty
you buy
much
a bond.
pretty much what that means is every time you buy a 10-year treasury, or I should say not every time, if you were to buy a 10-year treasury right now, you're losing 57 basis points a year on it. Now, why is this important to gold? Well, gold has a huge correlation to negative interest rate, to real yields. And when real yields are negative, the correlation to gold is inversed on the way up, if that makes sense. So we believe real yields are going to zero. Why? Well, the Fed's going to be tightening. And I promise you, to those that say the Fed will not tighten because of Ukraine or whatnot, I think you have to look at what the Fed is looking at to tighten. The Fed doesn't care what's going on overseas. The Fed cares about what's going on with the members of the United States in their purchasing power, job situations. All these things is what the Fed is focused on. I mean, I shouldn't say do they not care. Obviously, we all care about Ukraine and the situation that's going on there, and God bless them, and we hope that they find peace. But I'm saying from a policy perspective, they're not going to shift their policy in a way that's primarily focused on the situation in Ukraine. And we believe the Fed is going to hike. We believe that the Fed should have been hiking months ago. But if the Fed is going to hike, real yields will go higher. If real yields go higher, gold will go down. Now, why is that? Well, if real yields go up, the incentive to own gold isn't there because bonds become more attractive. Bonds are not attractive at this price, at this yield, right? And if you look back to 2018, right after we'll go back to our regime, we had this deflationary trigger here in the end of 2018, early 2019. At this point, real yields started fading. That's deflation. And this goes back to us, and we're going to encompass everything of why we don't see deflation as a high probable regime that formalizes. Now, it can definitely show up in the matrix as a very strong probability, but for deflation to formalize, we would need real yields to go lower, meaning people are going to press the bid on bonds at this negative yield, meaning they expect even lower yields down the road. Now, I don't see that as probable. Last time we saw negative real yields was back in 2013, and from here, gold got absolutely destroyed. We'll compare gold just to show those who are watching the video to understand there is a huge negative correlation between real yields and gold.
Yeah. So right now they're actually correlated for the last month or so.
Yes, and I think that's important to when you say hold on, let me add it back on there. When you say correlated,
maybe not the last
on
month, maybe more like the last couple of weeks.
Yeah, they're definitely more correlated in the last couple of weeks, and this goes. But let's change this to the bonds, right? Let's look at let's look at our bond futures. This is something we'll take DDAP off for the sake of the eyes, and so you can see what's going on. As you can see, these move together. These are pretty much linked and they move in tandem. The correlations are positive. You know, sometimes they drag, but they're pretty much positive almost all the time. Look at this now. You see huge divergence here. And in my opinion, I believe the divergence is due to the conflict overseas. I believe that this will resolve itself. For the aggressive traders out there, there's actually an arbitrage opportunity where you long or short gold, long bonds to compress that spread. Are we going to do it? No. I mean, that's a complicated strategy, and explaining that to other people probably wouldn't work well. Your best way is through futures exposure to prevent any like IV decay or option destruction, because VIX will affect equity options, and we believe that VIX can go higher. So your best bet is using futures contracts, and those aren't for the faint of heart. Obviously, there's a lot of leverage there, and you need to know what you're doing, and you should always have an account that is greater than the leverage that you're using. Meaning, you know, you shouldn't have a 50K account and putting on this spread that leverages out to 100 to 200K, because you can wipe yourself out.
Especially in this regime.
Yeah, exactly.
In this risk-off regime,
Especially in this,
stagflation is notorious for screwing people on both sides. Like, as we've seen in the last month, market would dip hard only for people to get short and then rip even harder to squeeze everyone. So,
right.
Funny thing to note too. So stagflation over history in our model since 1990, stagflation's performance on the S&P is around 0%. So, and funny thing, our stagflation triggered on April 12th. So if you go to SPY on the chart, go to TradingView.
Oh, you want me to go to TradingView? Okay.
Yeah,
and
yeah.
You want me to go
pull
to
up
SPY? Yep.
So we got a stagflation trigger on April 12th.
You want me to draw? You want me to draw horizontal for you? Yep.
Yeah.
Okay.
Do that.
April 12th. Here. That's the close. Let me make sure it's the close. It should come out to like 411 or something.
Yeah, it's around 411. And so stagflation performance works out to about 0% since 1990. And so that basically means when the regime changes. So
here, let me bring up the odds for you so you can harp on the
the odds are right there. So that's the S&P's performance in stagflation.
Negative 3 basis points.
Pretty much 0%.
Yeah.
And we just touched that.
It's funny. I was just about to say that. Let me take DDAP off because the lines may be confusing for those with small screens.
But yeah, we just touched that. So
yep.
And we've been calling that for the last few weeks now, that it's very likely that we get a regime shift either to deflation or to inflation expansion, whatever. It's going to happen around that 411 mark, because that's just historically, that's the average that it's been happening at. Obviously, past performance is not indicative of future performance, but the odds are in our favor that it's going to close. The regime is going to shift at that price point, roughly. Yeah,
I mean, if you want to be real scientific, you can go 411, right, and 49 plus, or I should say times 412. 72 is a 3 basis point. Oh, that's an incline. Sorry, whoops, gotta go decline, right? 411.49. Literally 411.36.
Yeah. So basically at the 411 mark. So
yeah,
that just shows this is not the dip to buy. This is not the dip to be leveraged in. This is about capital preservation right now. We're in survival mode. and you just got to preserve the capital and just hold out for when we have the next inflationary regime, and then that's where you go full leverage. That's where you go long tech, small caps, Zach Morris bullshit. That's when you do it.
Yeah,
that's
yeah, and
where
I think
that's where the odds are
that's a
in your
great way to
favor.
pull it. Yeah, that's a great way to say it. When it comes to leverage, like we'll look at the IWC, which is the microcap ETF. As you can see, we're back to January of 2021. We pretty much erased a whole year of small cap gains in what, 3 months, 2.5 months,
Yep.
right? So when this goes risk on, via either an inflationary or expansionary regime and its bullish trend, you can see that there's money to be made here. But when it goes bearish trend, more times than not, and we're in a risk off regime, obviously, more times than not, there's a whipping to be had.
Yep. And there's nothing
Yep.
wrong with being cash. There's nothing
Nope.
wrong with just taking a break. I mean, there are ways to play stagflation as we're doing with our spread, but it's really not necessary. When we get deflation, there are things to do on deflation because that's a more consistent downtrend and more consistent uptrend in bonds. So you can play TLT, things like that. But with stagflation, like nothing really performs strongly consistently. So you just have to wait it out. There's money to be
Yeah.
made. Sometimes
Yep.
being in cash and waiting it out is the best move, and
Yep.
that's proving to be true right now
And
over the last few
and,
weeks.
and for those crypto investors out there that want to know how this ties in to their portfolios, um, as you can see right now, at the time of this recording, Bitcoin is down 3.6% and Ethereum is down 6%. Let's go back to the regime model, or I should say the historical data. As you can see now, you're gonna have to take this with a grain of salt because the data only goes back to the first quarter of 2017 for Bitcoin and Ethereum, and in stagflation, Bitcoin is above Ethereum. Bitcoin outperforms Ethereum. Now let's go to other regimes. You'll see Ethereum tends to lead the way in pretty much all the other regimes. Expansion, Ethereum's on top. Inflation, Ethereum is on top. This is risk on, right? Bitcoin is the original. Ethereum is the derivative. Now, I know you can say whatever you want about smart contracts, the whole nine, right? But like Bitcoin is the original in crypto. When you say crypto, everyone knows Bitcoin. Ethereum is the subset of that, right? So when there's a flight to safety, aka risk off, it goes from Ethereum to Bitcoin and then to cash. Regardless of what you may think, this is what the historical backtests have shown, that Bitcoin will outperform Ethereum in stagflation. Now we can go and look at deflation as well. It should be very close, if not the same. Bitcoin, yes, and Ethereum actually is. I believe Ethereum is red or close to red.
Oh, it's right there. You just passed it. It's pretty much flat.
Oh, it's pretty much flat. That's what I
Yep.
could see. Yeah, no, I figured it was close to red, so I was looking red, but it's is it red actually? Let's see.
Can't even hover
Oh,
over it. It's that
oh
small.
no, no, no. It's 21 basis points. Like no, like I promise you, no crypto investors sticking around for 21 basis points.
Definitely not.
You know what I mean? Yeah. I
Yeah.
literally thought it was red, but I guess Ethereum came in with a slight little push above.
But
But
that's also a grain of salt. Crypto is so new.
that's
The
true.
like, yeah, it's been around for some time, but there's really only been significant volume, significant money going through it in the last few years.
Yeah,
So
it's
it's
2017. That's
yeah,
why there's a reason for the quarter one 2017. It's not just because we threw a dart at the wall and just like, oh, 2017. It's when volume started to pick up substantially across both Bitcoin and Ethereum, and that's why we were able to put it into the models at that point. We didn't want to go too early because Back in the day when Bitcoin was $5, it was moving 60% in a month, and that's
Yeah,
just unrealistic.
that's just not realistic data at
Yeah,
all.
yeah, yeah. So, as you can see, long story short, in risk-off regimes, Bitcoin is outperforming Ethereum. Reason being, flight to safety. Okay, you're liquidating risk and flying to safety, which is why you're seeing the price action that you're seeing. You're seeing that Bitcoin is down less than Ethereum. This is the whole point. Flight to safety. Now, in a risk on regime, it goes the complete opposite direction. It's Ethereum, like, anyone wants to call alt season, pretty much shitcoin season, whatever you want to call it. That's risk on regimes. Those are regimes where, like, either inflation or expansion, where you can pretty much throw a dart at anything and it will go up if it's not VIX or corn in expansion. Same in inflation, it's even better. Pretty much everything goes up, even
Yeah,
VIX.
you're just not going to outperform the SPY, but you're not going to lose money.
Yeah, you're not going to lose money, right? That's the point. The point is when you're in these risk on regimes, you can be more aggressive, and that's where our whole risk management model comes down to. As you said earlier, there's nothing wrong with being in cash. Absolutely not. We are in cash right now, or at least 35 to 40% cash. We have a couple of spread plays on, but there's really no directional position in the account, meaning we are net short technically, but we're not definitive, or I should say, specifically or aggressively net long or net short. It's marginally net short. Now, the reason why we are mostly in cash is, again, it pays to take advantage when the market's working in your favor. And to give some more details on what that means, um, a drawdown is a drawdown no matter where you are, but a detrimental drawdown is something else. So in a risk on regime, if I know the regime's risk on and I draw down 20%, which is a terrible drawdown from a portfolio basis, but from an understanding of the regime basis, knowing that we are in a risk on regime, I'm okay drawing down 20%, knowing that risk is still on and the prices will, with high probability, will go higher. Whereas in a risk off regime, I have no confidence price will go higher. So a 20% drawdown could become permanent depending on liquidity needs. This is the difference. Like I'm okay sitting there knowing I can wait out a dip because I'm in a risk on regime. Whereas um, we have no idea how long this risk off regime is going to last. I mean, we're already at the longest period of stagflation since 2008. Does this mean that we're going to shift soon? I'm going to clarify: shift, not shit. That we're going to shift soon. No, that doesn't mean anything. We can go right to deflation if inflation expectations really shit the bed, right? That could happen, or growth could pick up, and we can go back to an inflationary regime or even expansion, risk on, right? We don't know what's going to happen, and that's the key here: is that drawdowns and risk off regimes are indefinite. They are not indefinite if, in the sense that if you hold on long enough, you'll get your money back. They're indefinite that if you use leverage, which we do, we're an advocate for leverage, just intelligent leverage. Leveraging on an intraday basis is kind of mute because you have to have an algorithm, a machine, a system that works in such a tight time frame to make that profitable. Um, Looking with your eyes, or I should say your gut feelings, is not something that's scalable. And you see that right now where a lot of people are having trouble, where a couple of months ago, or even I should say a year ago, everyone was killing it. It was buy 10% out of the money calls, buy weekly calls, flip them around. People were making hundreds of thousands of dollars. Now, where are they now? That's the problem. Is risk off destroys the unaware. They don't understand that they are in a risk on regime, and they build an entire foundation of how they operate. And once that regime pivots, they're left holding the bag. So it's okay to to use leverage as long as you know when to stop. And that, I think that's what I want to harp on, Artie, is no matter what, a risk on or risk off regime, we have a portfolio play. It's either going to be long bonds or long risk assets. Bonds are unfavorable due to negative real yields. So we're pretty much left with cash. Now you can play some spreads where you're short growth and long safety. A play would be the short high beta, long low beta. But even that, it's not going to reward you or yield you with anywhere near the type of returns that we get in risk on regimes. We'll leave off with TMF. It's one of our main picks in a deflationary or risk off environment. And usually, as I said earlier, stagflation precedes deflation.
Yeah. So if we do get deflation, TMF, that's high on our list. We're
Exactly
prepping for that if that is the case. But we're not gonna go with emotions. We're not gonna go with gut feel. Our model reads the market. The market speaks in a language, and our model knows how to read that language. And there's no reason to act ahead because our model predicts deflationary regimes. It's a leading indicator. So we're going to sit back, relax with cash, chill out for the stagflationary period. We'll see how long it lasts. And yeah, we'll wait for the pivot.
And when it comes, we'll be there, and we'll be there, and we'll be square, and we'll be in it.
Yep. I think that's a good way to end it.
Yep.
If you got questions, which I don't know, I feel like there's so much to talk about. We don't want to have an hour-long podcast, but we got a Discord, and questions are welcomed. We'll answer them any time of day.
We'll change this as time goes on. We'll make this better. Obviously, anything that anyone wants to hear more about, we'll be glad to talk more about. And other than that, yeah, I think that's a great place to leave it off, Artie.
All right. Good first podcast. Hope you guys enjoyed.
Yep. Thank you so much. If you have any questions, feel free to reach out to us through the comments section, our Twitter @TheMarketRadar, or our Discord. If you'd like access to DDAP, please go to www.market-radar.com and sign up. Thank you so much for listening, and have a great day.